Thank you, Justin. Good morning, everyone. I'm very glad to be here for a second year. What I should say is that Justin should admit that he only invites me here for one simple reason, and that simple reason is to scare everybody in the room. And it's not just the face. It's because I'm here to set the scene of where the TV industry is today. And I'm going to do that with data. But when you do that, and when you drill down into some of the trends and some of the consumer behaviors, that can be a bit of a scary place. It can be a scary place for traditional broadcasters, for advertisers, for people who are placing content and advertising on television. But I've decided, as Justin alluded to be a bit more positive this year and to end with a Hollywood ending, a happy ending for everyone. But I won't disappoint. I'll start with lots of negative stuff. So let's drill straight down into that and set the scene. So firstly, we're going to be talking about SVOD, and we're going to be talking about streaming and inflection points and transitions. This is the US SVOD penetration, the entire rest of the world average at the bottom, and Australia and New Zealand, which you can see sit nicely in the middle. Now, I've put a nice dotted orange line around the penetration rates for Australia and for New Zealand. Those levels of penetration are important because what we've picked up, and I'm going to talk about this in more detail, is that there's a threshold at which the impact of SVOD on traditional TV kicks in at a much higher rate. It becomes much more damaging to traditional linear viewing. We'll talk about that in a second. Of course, in common with other markets, and you could plot this graph for pretty much any country, doesn't matter. This is Australia and New Zealand combined. Online advertising, past TV advertising, last year, the year before, whenever, but it's happened. That inflection point has passed. Of course, a lot of this is display and classified. It's not directly competitive with television, but this is the bit that is. And what we can see just looking at the Asian markets is that Australia and New Zealand are a little bit behind the other Asian markets and the US in terms of online video advertising as a proportion of total online. So the development of online video, the bit that is more competitive with TV, is a little bit retarded in these two markets. So let's get into the really bad news. And I've called it a tripartite TV tyranny. So I'm going to go through three key things that are impacting the TV market negatively. Firstly, why the shift to streaming? Why is everyone so obsessed with streaming when actually the SVOD market only accounts for about 8, 9, 10% of total television revenue? So why is Disney, why is Warner going after that 10% and not the 90%? Well, this graph illustrates it quite clearly. What they're chasing at this stage in the development is not scale. Of course, that's the long-term goal. At this stage, they're chasing growth. Because of those sectors, the streaming sectors are growing very, very quickly. That 90%, the TV advertising, the traditional subscription business, are in decline generally, or at least growing very slowly, depending on the markets that you look at. So that's the reason for the shift. What about the impact as more and more SVOD goes into market, penetration increases, and more people subscribe to those services? Well, there seems to be a pretty strong correlation with advertising, and that is a negative correlation. I said we were going to start with the bad news. So these are the Asian markets, Asia-Pacific markets, and you can see that the higher the penetration of SVOD, the lower share of TV that TV has of the advertising market. Interestingly, if this was a perfect correlation, Australia, you can see, sits above the line, New Zealand below. So Australia has a more robust TV advertising market than it should have, given the level of penetration of SVOD in this country. And that's either good news or bad news, depending on where you sit. It may mean that there's more bad news to come. Another big challenge is this one. And this, again, you can plot it for any country. All the data I'm showing you today is Australian, but this works in every country. As soon as a household takes an SVOD service, linear viewing declines. Happens everywhere. Now, you may say that's obvious. They watch more television, by the way. People who have SVOD consistently watch more TV, but less of it is linear. And everyone, when they see this graph, they say, what's going on with Stan? How come the decline is so big in a Stan household? The reason is these are not mutually exclusive. So most people who have Stan also have Netflix, and so the impact is bigger. But it's a negative impact on that linear part of the market. And here's the third, and this is the impact on pay TV. Because you see a lot of analysts stand up and say, SVOD's complementary to pay TV. It's a wonderful, wonderful partnership. Well, it's not, and it's not depending on the uptake, because what we can see is that 5–10% uptake of SVOD impact is minimal. At 15 to 25%, the impact starts to kick in. In fact, pay TV loses an average of 2.5% penetration over what it would have achieved if there was no SVOD at a 15 to 25% level of uptake. And at 35+%, that impact doubles to a loss of 4% every year over how they would have grown otherwise. And guess what? Australia has already passed that threshold at 42% unique SVOD penetration. Tiny bit more bad news, because there's a lot of people who say, well, you know, Netflix, of course, is going to start taking advertising. No, they're not. And I'll explain why we think they're not. Because a lot of the suggestion around Netflix and whether they will or won't take advertising has rested on an examination of their finances. Everyone knows Netflix is spending massively on content. They take the hit for paying for that content immediately, and they amortize it over several years. And the impact of that is a negative free cash flow, which currently stands at about -$3 billion a year. So not a very attractive thing to have in your annual report. However, 6 months ago, we did a piece of research and we did a few calculations, and we came up with a report where I said that free cash flow hole has a $2 solution. In fact, it was a $1.67 net of tax solution, but let's call it $2. Basically, all they need to do is to increase their value per customer, their ARPU, standard measure in pay TV, by $1.67 to completely wipe out that free cash flow deficit. They've been pretty successful at increasing ARPU. In fact, it's increased by $3 over the last 3 years. And they do that by tiering. So they add on additional higher cost tiers, just the standard pay TV model. But then in January this year, guess what? They announced a price rise by $2. So that's going to get them there even quicker. And if we plot that and back calculate what would have happened if they'd made $2 more per customer, you can see that that free cash flow deficit is wiped out completely. So they do not need to carry advertising. And another point about Netflix is that actually advertising becomes less attractive on Netflix than it was 3 or 4 years ago, because their viewing is in decline. That's right. 3 years ago, people watched nearly 2 hours of Netflix content a day, and now it's more like an hour and a half. And the reason for that, of course, the market is much more competitive than it was. Netflix pretty much had it all its own way 3 or 4 years ago. So actually, if you then do the calculation, and I haven't got the slides on this, but I have done it. If you do the calculation 3 years ago, switch out your subscription model for advertising, it kind of would have made sense. But it doesn't anymore because of that decline in viewing. So let's move to the second half, the Hollywood ending, the good news for TV. And I think actually a lot of what Kim was saying in that opening presentation pretty much sits with where I think we are in the evolution of TV and why that's a positive thing generally for advertisers and for many other business models. And it's to do with the stage we have reached in terms of the evolution of the concept of TV, the concept of a television channel, when in the context of the Netflixes and the streamers and the Disneys and the direct consumers and all those phrases that I'm sure are in that pamphlet that Kim was talking about in the bag. But we're at another inflection point. And TV's evolution is going so quickly, but it's all about inflection points, and they seem to come every 6 or 7 months. We're at an inflection point that is positive for advertising. So there's a fundamental shift in power, and that fundamental shift is about content. The content you enjoy on Netflix, those high-end, high-budget dramas. In fact, Netflix, Amazon, and Hulu now account for 1 in every $4 spent on content in the US market. They are significant players and spenders, and that content is driving their competitive position. Australia, in common with other markets that we look at, is no different in terms of consumer behavior around SVOD services. So people don't just take one service anymore. In Australia, on average, each SVOD customer actually takes 2, and it's higher in places like the US. Generally, Netflix is the core of that stack. So that in-home multi-SVOD stack, people start with Netflix and then they'll layer on perhaps Amazon, perhaps Stan, or a local service. And you can see that in these statistics. Netflix alone is the biggest segment, Netflix and Stan the next biggest segment. So those mid-tiers are being layered on, those mid-tier content players, those local content players, and ultimately that can of course include broadcast-led VOD streaming platforms or channels. But there's a negative, if you're an SVOD player, to stacking. And that is that we can see in households that have only one SVOD that they watch about 1 hour 42 of content a day on that service. Take 2 and they watch about 2 hours, so a bit more, and 3, 2 hours again, they don't watch any more. So as they stack and stack and stack, they go up a little bit in viewing, but not enough to account for all the multiple services. And what that means is viewing per service declines. And you can see that in that Netflix graph we were looking at earlier. That means that SVOD services are facing exactly the same dynamic that TV faced 20 years ago. When I started covering this market, it was an analog market. And there was a massive panic because this disruptor came along that was called digital TV. And we suddenly went from 5 channels to 500. Mass panic, what do we do about it? Well, we launch families of channels. So we retarget, we target niches of scale. We have a kids channel, a music channel, a general entertainment channel. And that now that we're in a non-linear world, you can do that without launching lots and lots of brands. Of course you can, and Disney's talking about keeping ESPN and the streaming brand, having Disney Plus and Disney Play and maybe a few others, and Hulu as a separate brand when they go direct to consumer. So you can do the channel family, but you don't have to. The other thing that we're picking up is that a number of the most highly penetrated SVOD markets seem to be tapping out or reaching a ceiling in terms of stacking. So quarter on quarter, consistently from all the years we've been following this, you could see a step up in the number of services people took. Pretty much consistent quarter on quarter. The last 2, 3, 4 quarters in some markets, that's leveled. So people aren't stacking more and more and more. So we're reaching a threshold, probably a temporary one, around some price sensitivity, but that's a whole other story. Happy to tell you that, but it's probably a temporary one. But nonetheless, we are at a ceiling. And guess what? You all know this. A load of major studios are about to come in to that SVOD streaming space with direct-to-consumer solutions and plays. And so that inflection point that I talked about, that I think is generally positive for advertising, is this, that we are at a point where we need to diversify away from the dominant model in SVOD to date, which of course, as the S in SVOD indicates, is subscription, and diversify business models. So as we hit this point where stacking is flattening, viewing is declining in individual SVOD services, loads of new players about to enter the market, how do we sustain that financially? We do it with business model diversification, and that of course means advertising. And what it actually means is that we dismantle the whole concept of SVOD and streaming and the differentiation between that and television, in inverted commas, or traditional television, and that distinction disappears. It just becomes television again. And the business models are already there. And whether they're subscription or advertising, well, they'll be both. And one final chart to show you that I think is interesting and informative of why that's likely and important. In January, back when Netflix announced its $2 price rise in the US, Hulu came out the same week and said, we're going to drop prices by $2. Fantastic PR, fantastic move, especially because for their ad-supported SVOD service, they actually make $12 more per customer than for their ad-free service because of the additional advertising model, revenue. So the mixed business model can be a strong positive within the streaming space. And that's the inflection point that I think we're at. That's the positive, that complete dismantling of these false distinctions, increasingly false distinctions between channels and streaming and television, and traditional and pay TV. That is disappearing because of this. And that is my Hollywood ending for you. So thank you very much.
Okay. Guy, for the ladies and gentlemen standing over there, we have got seats here if you want to just walk through, don't be shy. Guy, that was incredibly awkward. I was sitting between Seven and MCN during all that. Terrifying. I don't know why I invite you, in fact. But it was brilliant, as always. And people actually were texting me asking for your slides, and I think it clearly illustrates some of the issues that we're facing, and that's why the market is changing as dramatically as it is. Does anyone have a question to put Guy on the spot on all those lovely statistics that he came out with? Anyone? We do. We have one here, the guy with the beard. Hang on a moment. We do have a microphone. Derek? Yeah, just the guy on the right there. The beard. Do you mind saying who you are?
Thank you for that presentation, mate. My name's Michael. I'm from Bench, so programmatic advertising. I just want to ask a question regarding duplication of content across SVOD platforms. Would you see that as becoming more of a common theme with the stacking of SVOD services, just so people and I guess Netflix and Stan having the same show to actually duplicate that content and buy those rights as well, so that keeps people on their platform rather than I guess diluting the viewership on other platforms as well?
So do I see effectively cross-licensing of content within a single market as an increasingly prevalent trend? No, I don't think so. We do actually analyse that title by title. We track every title that is on SVOD, and we can look at the overlap. Overlap between Netflix and Stan in Australia is 382 titles, so there you go. 5,000 odd are exclusive on Stan and Netflix. So I can't see those numbers shifting much because it's not competitively interesting at the stage we're at in the market. So no, but there's always some cross-licensing. And a lot of that is driven by co-production relationships, which are a lot more prevalent outside the US than they are within the US.
Okay, wonderful. Guy, knowledgeable as ever. Let's give him a big round of applause. And